Major moves. We going all in, like we got nothing to lose. We making moves. We making major moves. We making moves. We making major moves. We making moves.
Welcome back to my channel. I want to thank you guys for actively deciding to spend time with me. I'm just a guy in a Spider-Man mask, a cool one I might add. I'm not a financial advisor. I'm just providing information and content already on the internet, and I just read it and present it to you guys in a way that may reach you or may not reach you. Whatever the reason is you found my page, I'm grateful you're here, and thank you for spending time with me. Let's get into this. What is up, everybody? I am Mr. Man. I'm a grown-ass man in a Spider-Man mask, and I appreciate every single one of you guys that watch, enjoy, soak up my content here. I've had a few people come on my channel already, and I'm sure it's going to continuously grow the more my fan base grows and the more my subscribers begins to grow as well, or continues to grow. Come on the page and just talk nothing but nonsense and shit. Why? I'm out here doing a service for the world, essentially. Anybody willing to listen. I'm helping you guys learn. I'm educating you guys. I'm helping myself learn with the comments and questions that you guys have as well. I drop knowledge about the banking industry. I drop knowledge about cryptocurrency. I drop knowledge about real estate. And I have jackasses coming to this page saying, why would I take advice from a guy in a Spider-Man mask? You know what? At the end of the day, that's up to you. I'm just here to drop information for free, non-biased at all. I'm trying to help you guys out. If you choose to take information or not, that's no dirt off of my shoulder. I can continue with my walk either way. I'm just here. I've been called to do what I'm doing. And the reason I wear a mask, because at the end of the day, when this is all said and done, and should I happen to come into wealth due to the investments that I hold, the technological investment, well shit, I want to live a free life. Nobody needs to know who I am. The true diehard Mr. Man fans will know who I am. You'll see the tattoo here. Like, I'm not stupid. I'm not oblivious. Got a tattoo right here. You'll know the voice. You'll know who I am. The diehard ones. The ones who won't recognize me, good. Don't need you in my life. So, let's jump into this now. I went for a nice 2K run, just a short 2K sprint. I was bringing in 4 minutes and 30 seconds a kilometer, and that was a nice sprint. Helped level me out before I run, and I have a nice little puff, a joint there to give me my focus. It just kind of narrows everything down, helps me compartmentalize my life. When I go for a run, I'm focused on the run, and that's it. No pain in my life, no game. So today's video, or today's information I should say, today was very interesting. So I found myself locked out of my Twitter account. I was suspended. I'm not sure. All I can do is peg it to two comments I had made today. I was talking to Shannon Thorpe. Someone asked what Shannon Thorpe was. I had posted a bit of information about her. Then I went and challenged her because, somebody was asking who this person is. So I went and challenged her. I was like, hey, how comes you as a treasurer working in a bank, not 100% sure which bank, but you in the treasurer position can openly speak about XRP? How can you do that without ramification? Meanwhile, every video I watch, not every, but majority of these videos that I watch, everything that I read, they're trying hard not to say ripple, the ripple effect. We're working with a protocol for this, or we're working with that, and you have to make the connections. You have to be smart enough to make the connections. Meanwhile, she's out there, XRP's this, XRP's that. That's lovely. I'm right in line with that. I agree with the things you're saying. That resonates with me. My question is, however, how are you able to do that without ramifications? I didn't think that was a bad comment. And then I furthered that comment and said, Shannon Thorpe seems like a nice, wonderful person. I couldn't see her not taking the noble route and answering the question, or she could choose to ignore me and not answer my question at all. And that's just the reality of it. Like, I was just making a fact. I wasn't putting anybody down. I wasn't making fun of nobody. I wasn't being rude. Just a fact. Anyways, let's jump into this today. Today's facts here. Should things happen the way I'm forecasting it to happen, my last day of work, and I'm going to take you guys through this, is December 29th, 2023. On December 1st, I'm submitting my resignation letter, and I have it here with me already. And I want to show you guys it once this, where the heck, there we go. Bring that down. There we go. I want to share my resignation letter with you guys. Of course, I had to redact it, but not redact it in terms that you're familiar with. I changed the names, obviously, to my birth names and my manager's birth name. Dear Mr. Man's manager, but this is all from me to my manager. This is personal here, because I've worked with that company for 5 years now. At the place I work, regarding resignation letter, Mr. Man. To Mr. Man's manager, the person responsible for maintenance. I would like to take this opportunity to thank you personally for helping me grow in my life, in the position, and with the company family. But especially the time that you and I did get to spend. You poured wisdom and experience into my path, and I'm appreciative for it. I found bodily autonomy within this company, and as such, trust was immediately established between us. I am writing to inform you that my last day of work with the company and team will be December 29th, 2023. During the lead up to the December 9th, 29th date, I will gladly assist and train any new personnel stepping up to this position. What is the exit protocol, which will ensure that I follow procedures and exit my position in the best note possible? With great respect, Mr. Man. You guys are the first people to see this. I am manifesting this into my life. My partner and I are going to the Canary Islands, either January or February, or for January and February. And that happens directly after I walk out of this position here. At this point, I'm free. Don't have to get up to go for a 9-to-5 job while we're out there, because I own rentals and because I feel we have done them and run them properly. Money will come in on a monthly basis. Regardless, we have our Airbnb and we have the new operations that we've set up in terms of the mid to short term contracts for contract workers, such as highway personnel, such as construction workers, such as laborers of sorts. So people want to act like jackasses on this site and say, well, what do you know? A guy in a Spider-Man mask. Here we go. I can live my life free. At my choosing, I'm walking away from it. And while doing that now, I'm going to learn to be self-sufficient on my own. I guess that's the same thing, self-sufficient. I'm going to be taking up like snowblowing jobs. Not jobs, but get some contracts of my own. You know, I have a little snowblower, looking to invest into a new snowblower, a nice big one, so I can push that up and down the road on my trailer and mow people's lawns, or their driveways, sorry. And come summertime, I'll do some lawn work. I'll cut grass, I'll cut trees back, I'll do hedges, you know, just things you've learned over. I can fix a bit of machinery as well. We'll see where life leads. I'll do it on my own. I'm independent. So let's jump into this now. I can't see my mouse. Oh, can't. Okay. There she is. Okay. So I want you to hear this, okay? December is a key date, okay? This is the same December that I'm resigning from my position. Listen to this. Hold on, let me just mute the mic here.
Working on deploying tokenization-based solutions and infrastructure. It's a long build. So 23 is the year where we're building this, where we are going to have some water in the pipes, basically. Some initial deals, some transactions that you're seeing here and there, but institutional grade. What we've seen before was non-institutional grade assets going to retail and things like that. What we're going to start to see, just like KKR, but others as well. I had a conference in December, which I call The Asset Managers Are Coming. You know, we had Hamilton Lane on stage in Aberdeen, and you know, the likes of BlackRock are in the market, the likes of Vanguard and so on. So JP Morgan, as I said, Goldman Sachs, Citibank, they're all working on it. So 23 is the year where we're building the infrastructure. 24 is the year where it can start to scale. But like any digital revolution, once it starts scaling, it's quite exponential because it's very easily replicatable.
So,
perfect. Did you hear that? Scalable, exponential. So the way that works, is that
on
what the heck? Is that when these bank stocks drop, they're going to buy their own stocks again at a cheaper valuation. I'm going to buy these stocks then too. I'm just telling you what I'm doing. I'm looking at stocks like JEPI, the JP Morgan funds right now. Their dividends or their yield percentage is at 10.8, I believe it is. So the more you hold, the more dividends you get. And they pay out on a monthly basis. So there's another form of income as well. And JP Morgan, I don't care what anybody says, they are not going anywhere. BlackRock isn't going anywhere. They will have new competition from the likes of you and me. You better believe that shit. But that's one of my strategies as well. Dividend play. So I want you guys to see this here. This is talking about the debt market now. This question is very well worded, and the answer this guy gives is just solid. And they go into XLM, their treasuries, and Franklin Templeton, and how their structure is set up essentially, in terms of there can be a mismatch in the market in terms of liquidity and non-liquidity. Okay, sorry. Where is it? I'm just gonna shut the mic off here so it doesn't interfere.
More and more traditional financial institutions entering the market for that reason.
Thank you. So, Pat, let me ask you the most difficult question here on the panel. I'll just pick you like that. So we hear from Carlos that all the big managers, hundreds of billions of dollars, are knocking on his door. He can hardly manage with the traffic of the inquiries. Australian government is behind it. You've got a suite of insurance product around tokenization. So it is happening. There is momentum here. Shall we be worried about the liquidity mismatch? What happens if we sell fundamentally illiquid assets like infrastructure, houses, private equity, and suddenly everyone wants to sell? So shall we be worried, Patrick?
Yeah. Hi, everybody. First of all, thanks for having me. My name is Pat Horrigan. I'm the founder of DeFica Frictionless Markets. We're a Luxembourg-based fund and tokenization platform. We focus specifically on the debt markets. So that question is really apt for debt markets. I think there's sort of two questions in it. One, what are general challenges, and then what are very specific challenges. So general challenges, anyone who's interested in this area, I encourage you to go web search, Google search, FSB, Financial Stability Board, DeFi report from last February, just gone. It's interesting stuff. It kind of points out many of the real challenges that I think Carlos and his team at Securitize and anybody who's in this area has uncovered over the last number of years. For me, there's sort of two general areas. If you intend on asset managers using blockchain, what you're really intending on doing is bringing the best caliber products on chain. That's really what it's about, right? So if you're bringing the best caliber products, those caliber products are managed professionally by high caliber investment managers and asset managers today. Those asset managers are well capable and have a strong track record of dealing with scenarios like liquidity mismatches. So today, when you look at why isn't there a plethora of these asset classes on chain? Like, the first reason is the unit economics actually don't quite work just yet. There's a good example of this, the Franklin Templeton Money Market Fund. It's a US repo and treasury fund. It's knocking out about 4.5%. It's based on Stellar's treasury, mostly. But the management fees in that and the operational expenses are about 8.5%. So you're literally losing money, right? Now it's subsidized for the moment, but the costs that are in there come from the fact that you're running two ledgers, a traditional ledger system, and you're running an on-chain ledger system. So those costs have to be addressed, right? And the best way they get addressed is by having more participants and more competition in the market. So that's the first thing. The second thing is most asset managers, in general, seek to lower their levels of risk. Those risks are split across a whole different range of risk classifications. One thing for certain is that they will not take on currency risk. Right? It's just not necessary, because when they deal with tokenization, they got to deal with technological risk, operational risk of these smaller companies because they're startups. They've got to deal with lots of other risk structures. Currency risk is one of these big issues. much is made about this idea of atomic settlement or instant delivery versus payment in the tokenization space. In order for that to actually work, you need a super, super low cost currency that moves frictionlessly across boundaries. Today, if you look at the cost structures that are in place for qualified custodians, they're outrageous. You're talking about 30, 50 basis points. Some of these money market funds, you know, they can only survive on 20 to 30 basis points of costs, right? So those are big challenges. Eventually they get overcome. Regulatory is another one. You look in Europe. In Europe now we have the European Financial Digital Package that's at various stages of adoption. You have MiCA, you have the DLTR regime, you have DORA. You put all of those things together and suddenly you're giving regulatory comfort to larger asset managers. Just a question about liquidity mismatch. There's sort of this, I think 5 years ago, and maybe still today, some people believe that tokenization endows magical properties on an asset class. Yeah, it doesn't, right? It really doesn't. It promises different aspects and different characteristics. So one of the things that it promises is that you can frictionlessly move these digital securities across different boundaries. But you can really only do that within safeguards and guardrails. So when you look at liquidity mismatching, this is probably one of the biggest areas for regulatory intervention in the traditional markets today, right? Wind back 6 weeks ago when SPV failed, that's a liquidity mismatch. FTX, that's a liquidity mismatch, right? It's when the actual redemption of the fractionalized tokens that you have, those redemptions outstrip your ability to liquidate the underlying assets. It's not unique in the tokenization space. It happens in mutual funds. You can go, again, web search, look for ECB reports on liquidity mismatching in open-ended funds. This happens all the time. So it's not unique, or it's not an ailment specifically to tokenization. It does present an opportunity, though, because if you look at how tokenization functions, there is an opportunity for larger balance sheets to come along, market makers to come along, and to provide the liquidity that's needed in order to have shorter term redemptions on longer dated underlying mature assets, right? Those are, I think what will happen over time is that you will see asset managers becoming comfortable with the fact that their assets, first of all, can be tokenized and distributed safely within the guardrails that are there, but then you also will have more participants coming into the market to provide the necessary liquidity to keep the system juiced. I think that's what will happen.
I just want to comment on the liquidity issue, because obviously one of the main reasons the asset managers want to tokenize is obviously for operational efficiencies, you know, eliminated reconciliation errors, being able to, you know, scale to more investors, etc., which talks to what Pat was saying about the fees of these funds, right? So if they can actually become digital, then they can actually reduce the cost of operating a fund, and then they can reduce the fees. So that's one aspect of it. The other one is liquidity, right? Because obviously one of the reasons why many asset classes like private equity or venture capital, etc., are not actually, you know, suitable for individual investors is because it's lack of liquidity. Because, you know, if you're a pension fund, you know, you can just take a long-term view on an asset, 10 years, invest it, leave the money there, it'll come back at some point in time, etc. But if you're an individual investor and you don't know what your personal situation is going to be, you can get fired from your job, or, you know, or you get married and have 4 kids and you need money, or you get divorced and lose half of your money. Like, you know, there's so many things can happen in your life that requires that your assets have some degree of liquidity. Now, so how do you solve for liquidity for illiquid assets? So, well, there's 2 ways to do it. One, what Pat was referring to as trying to liquidate the underlying assets to provide liquidity, and that's where it gets tricky because, you know, first, it might not be easy to liquidate the underlying assets, and second, there might be a liquidity mismatch, that those assets are actually not worth enough at that point in time to be able to return the money, which is what happened to the banks, etc. I disagree that this is what happened to FTX. What happened to FTX is they didn't have the money because they stole it, so that's a different problem. But what happened to SVB was not fraud, right? It was just basically liquidity mismatch. Now, there's another way to provide liquidity, which is having somebody else to buy the asset. And if you think about how it works in traditional finance, if you're a very large investor and you buy $100 million on a private equity, you know, healthcare fund from KKR, which is the one we tokenize on Avalanche, you're going to find somebody to buy it at, you know, a discount from the net asset value of the fund. Let's say, you know, 85, 90 cents on a dollar. But if you have $100,000, not $100 million, nobody's going to bother to do it, because the whole process of like buying a piece of a private equity firm is just so cumbersome and it's so costly that it doesn't scale well. So what tokenization really brings to the table is not necessarily that it enhances liquidity for any magical reason. It's just that it automates the process of, identifying the provenance of the asset. Yes, I own this because I have the token, being able to move it in an efficient way to another owner, being able to settle the trade quickly without counterparty risk. And that allows, the liquidity providers that work at large scale to come down and, operate at a much smaller scale. So that's where liquidity, I think, is going to come, and not necessarily because the asset itself is something that is liquid. We're also tokenizing, credit funds that have daily liquidity with Hamilton Lane, and we use tokenization as a way to, improve the redemption process using USDC and all that stuff. So that's a different part of the industry. But for liquid assets, the liquidity comes from liquidity providers, not from the asset itself. So.
Perfect. Did you get all that? And there's a mismatch of liquidity in the system there. Someone needs liquidity, meanwhile someone has to redeem that liquidity to provide that liquidity that the other party needs, and they don't have that liquidity. There's a mismatch, and then you gotta run on the bank like SVB at that point. So they're capitalizing on, Franklin Templeton is capitalizing on Stellar because they offer liquidity, sort of like, well, exactly like Ripple, but in a different means. So that's why they offer micro payments, because the payments to utilize and capitalize on the XRP ledger or the XLM protocol and their ledger is very, very minuscule in terms of what you have to pay, so they can offer liquidity. All right, guys, I do appreciate you guys coming here, listening to what I have to say. A lot of love, a lot of respect from me to you. I thoroughly enjoy that you guys want to hear about cryptocurrency from my take and my point of view, and hear what I have to offer, as well as real estate. I have a lot of love and a lot of passion for real estate, and want to continue to regurgitate information from me to you into your life, and hope you find value in that as well. Love you guys. See you on the next one.
Making major moves. We going all in. Like we got nothing to lose. We making moves. We making major moves. We making moves.